Let's go over this one more time because I'm sure it's kind of confusing. We're also going to use a worksheet in the classroom to help you understand this process a lot easier. So these are just concepts for you to look at and try to internalize as we do this. So let's summarize the adjustment process. Here we go. First of all, we talked about prepaid expenses. And examples were supplies, prepaid insurance. You could have prepaid wages, I guess, if you wanted to have. So anyway, these are examples of expenses that would need to be adjusted. So you would debit the expense account and credit the asset account. And as you see, supplies is an asset and prepaid insurance is an asset. The entries would look like this: supplies expense, insurance expense, and the impact. You always want to sit down and think about what will this do if I don't do this entry. And it's shown here, the income statement, the impact would be on revenues, expenses, and net income. It says no effect on revenues, which is correct, but the net income would be overstated without that. On the balance sheet, your assets would be overstated. No effect on liabilities, but your owner's equity would also be overstated then. So the other one they showed was unearned revenues, and I believe they show us two types of unearned revenues. First one is where you've already received the money and you have set up a liability. Examples of that would be magazine subscriptions, fees that were received in advance. I think in this case we used rent. Somebody paid rent 3 months in advance. So you created an account that said unearned rent and debited the cash account at the time. So now you're going to take some of that unearned rent out, okay, and put it into revenue, which is what this entry is right here. Unearned revenue gets debited, which decreases it, right? And rent revenue gets credited, which increases that. Now the accounts affected on the income statement, obviously the revenues. If you don't do this, they're going to be understated, and then the net income is going to be understated. No effect on the assets, right? But the liabilities would be overstated, and the owner's equity would be understated in this instance. Now here is another one about unearned revenues or accrued. Let's see the difference here. This one says unearned revenues, okay? Which means we've received the money, but we haven't earned them. This one is accrued revenues, which means we haven't sent out probably any invoices. We haven't recorded this anywhere other than by an agreement. So in this case, these are accrued revenues that have not been recorded anywhere and no money has been received for them. The difference between the unearned revenues and the accrued revenues. So you have services that you're going to perform, and there's an understanding about it. And you perform some of those services, but you haven't billed for it yet. So now you're going to bill for it. In essence, you're going to create an accounts receivable for them, and you're going to recognize the fees that you've earned. And that sets it up. It's going to, if you don't do this, your revenues will be understated. Your net income will be understated. Your assets will be understated, because you will not have created the accounts receivable, and your owner's equity would be understated. In the end, this is what the journal entries all look like. You would take these and then post them to the general ledger. Now we've got some more to look at. Let's look at Here is one for accrued expenses. And this one is wages or salaries. Again, accrued means they're there. We just haven't paid them. We haven't recorded them, so that we need to do that. And this was the wages. 2 days work was done within this period, and nothing had been paid out. So you have a wage expense, and then you create a wages payable. Again, you can see the effects. Your expenses would be understated, and then your net income would be overstated. Liabilities would be understated because you wouldn't have the payable showing, and then your owner's equity would be overstated because you've not reduced it with the expense. The other one is depreciation expense, and we talked about that one. Fixed assets are going to be depreciated out over a period of years, more than likely, and each period you have to update that. And this is where we created that accumulated depreciation account, and that was a contra account, remember? So the entry is $50 for the expense, and then in the accumulated depreciation we're going to credit. And here's your effect again. Expenses obviously would be understated, and net income overstated. Assets would be overstated because remember, this is a contra account that goes against the fixed asset. So fixed asset is a debit, and the accumulated depreciation is a credit account. Here's the entry for that, for these. These would then be posted to the general ledger. And after all that posting, we're going to prepare an adjusted trial balance. And the purpose of the trial balance is to verify that we're still in balance. You know, total debits and credits in the general ledger are balanced, because if they aren't, you're going to have to go back and fix them. So you're going to pull those off, and you'll end up with something that looks like this. By golly, they balance, and now we're ready for the financials. So our next step is doing financials in the next chapter. Thank you.